What if I told you some of the richest investors don't care if the market goes up or down? They still make money either way. Most people pick stocks on a hunch or recommendation, but quants are different. They use math, data, and AI to make predictions. Then they place their bets using assets like currencies, options, futures, and swaps, turning market swings into profit. Let's see how they do it. Let's look at Apple's stock in 2024. It began the year falling, then rose quickly, stayed flat for a few months, and went up again near the end. How do you model that with math? One straight line won't work. The chart is far too jagged. You could piece together a few lines, but that leaves a problem. How do you know when the change is coming? One way to approach this is by looking at the percent change in price from day to day. In finance, that's called the return. You'll hear it all the time. No need to overcomplicate this. Returns just means percent change. Simple as that. Imagine a plot of Apple's daily returns for 2024. Time runs along the bottom, and the return for each day sits on the vertical axis. This plot shows how unpredictable stock prices really are. Every dot above the time axis is a day Apple went up, every dot below is a down day. A couple things stand out. More days are up than down, and the spread of returns stays fairly consistent over time. Beyond that, though, it seems random. Here's where things get interesting. If you change how you look at the data, patterns start to show up. Let's take those returns and sort them into a histogram instead. Does that shape look familiar? It's the bell curve, the most famous shape in probability and statistics. Now picture this. Let's lay a smooth curve over that histogram. It follows the data's shape pretty well. Tall in the middle, shorter at the ends. It's not a perfect match, but it's close. Closer than you might think. In finance, you see this pattern showing up again and again. It's called the normal distribution. It doesn't catch every little twist, but it does a solid job of fitting the overall shape of stock returns. Want to see how common this is? Take a look at histograms of returns for Nvidia, Meta, Google, and Amazon from 2024. All four resemble bell curves, and their centers all sit pretty close to zero. Let's pause here because normal distributions are key. How do they actually work? A bell curve comes down to just two numbers, the mean and the standard deviation. The mean shows us where the center is, and the standard deviation tells us how spread out the values are. In finance, we call the mean the return, and the standard deviation is known as risk. Let's step back and think bigger. There are thousands of stocks out there, each with its own mix of risk and return. But here's something else to consider. Some stocks move in ways that are related to each other. The correlation measures the degree to which two stocks tend to go up or down together. To tie risk, return, and correlation all together, we use a higher dimensional normal distribution. Take two stocks, for instance. You can picture them with a 2D normal distribution, shown here as a surface. Look at it from one side, and you'll see a bell curve. Turn 90 degrees, and there's another bell curve. But if you look straight down from above, you notice an oval. That's the sign of correlation. Quantitative finance is a big subject with high stakes. To help you learn it all, Socratica has projects, demos, quizzes, study sheets, and more. And courses? We have those too. You'll find it all at socratica.com. Let's think about scaling this up. If we're modeling more than two stocks, we're dealing with even more dimensions. Take a portfolio of 500 stocks. It needs a 500-dimensional normal distribution. That means figuring out 500 means, 500 standard deviations, and nearly 125,000 correlation values. Here's the catch. We're short on data. On average, a month has 21 trading days, so we're looking at just 10,500 daily returns. That's nowhere close to enough to estimate risks, returns, and correlations for all 500 stocks with any real confidence. To make solid estimates, quants have to come up with smarter models, find more data, and use some clever statistics. This is one of the challenges you'll face in quantitative finance. Most investors buy stocks, bonds, or funds. If the market goes up, they're happy. If it drops, not so much. But pros take a different approach. They can make money even when prices drop, and it's called short selling. Here's what it looks like. Instead of buying a stock, you sell it first, usually borrowing shares you don't own. You take the money from that sale, then wait. If the stock price falls, you buy it back at a lower price, return the shares, and keep the difference. But if the stock climbs instead, that's trouble. Let's explore a strategy that uses short selling. Imagine two companies, Alpha and Omega. These could be two tech firms, two automakers, or any pair. Based on the models we've built, we think Alpha will outperform Omega over the next 3 months. Now, I'm not saying Alpha will go up or Omega will go down. I'm only saying that Alpha will do better than Omega, whether that means rising more or falling less. Let's say Alpha is priced at $50 per share, and Omega is at $40 per share. To set up the trade, I short 25 shares of Omega, taking in $1,000. Then I use that $1,000 to buy 20 shares of Alpha. At this point, I haven't put up any of my own money. We call this being short Omega and long Alpha, and this is what we mean by a pair trade. Jump ahead 3 months. Both stocks have fallen $5 per share. Alpha's now at $45 and Omega's at $35. Let's walk through what happens next. I sell my 20 shares of Alpha and get $900 back. I buy 25 shares of Omega to return to the lender, which costs $875. After closing both positions, I have $25 left over. So I made $25 in profit, even though both stocks dropped the same amount. How does that work? It's all about percent change. Alpha went from $50 to $45. That's a 10% drop. Omega dropped from $40 to $35. That's a 12.5% drop. Even though both stocks lost value, Alpha outperformed Omega, just like we predicted. This example demonstrates a few big ideas. In finance, you can go long to profit when an asset rises, or short to profit when it falls, but here's the key: price alone doesn't tell the whole story. What really matters is returns, the percentage change, and in this trade, Omega had the worst return, which is why we made money. We began by modeling individual stock returns, then moved to a pair trade, a bet on how two stocks relate to each other. The next step? Scaling up to a portfolio, a carefully chosen collection of stocks. Our goal is to take our math predictions, balance risk and return, factor in correlations, and construct a portfolio that gives us the best possible trade-off between potential profit and risk. One standard way to build a portfolio is with mean variance optimization, a mathematical technique that searches through all possible portfolios to find the best balance between expected return and risk. Let's explore this technique with a portfolio of all the stocks in the S&P 500. Imagine we've got models that give us estimated returns and standard deviations for each stock, along with the correlation between each pair of stocks. To organize this information, we bundle the expected returns into what's called a return vector, a list of 500 numbers. We put the standard deviations and correlations together into a covariance matrix, a 500 by 500 grid of numbers, but there's one piece missing: how much money to put into each stock. We use something called a weight vector to handle that, a list of 500 unknown values where each number shows what percentage of our money goes into each stock. Our portfolio will behave like a new normal distribution. The expected return is given by the dot product of our weight vector and the return vector. The risk, or standard deviation, is calculated using matrix multiplication with our covariance matrix. Now we need to put our preferences into math terms. We want to maximize returns, so that term is positive. We dislike risk and uncertainty, so let's make the risk term negative. But how much do we care about risk? That depends on risk aversion, a number we include as a multiplier in front of the risk term. This entire expression is called an objective function, sometimes called a loss function. Our goal is to find the weights that make this expression as large as possible, balancing return and risk according to our preferences. But before we optimize, we need to decide what kind of portfolio we want. Are we sticking to just long positions? That means all the weights need to stay positive, and they should add up to 1 so our capital is fully invested. Or do we want both long and short positions? Then some weights will be negative, representing the short positions. Should the portfolio be market neutral? That means the sum of all weights must be 0, balancing the longs and shorts. Each of these requirements is called a constraint. With our objective function and these constraints in place, we can use software to calculate the optimal portfolio, one that pushes our expected return as high as possible while keeping risk in check. With our list of weights in hand, we can turn them into the exact number of shares to buy or sell short for each of the 500 companies. Sure, you could do this by hand, but let's be real. No one's sitting there entering in 500 trades manually. Nowadays, a simple Python script can automate the entire process, executing all the trades for you in seconds. This is just the start of what you'll discover in quantitative finance, but quants have a lot more tools in their toolkit. Today, quants use machine learning to predict trends and tap into new kinds of data. For instance, you could analyze credit card transaction data to see how consumer spending patterns are shifting. Or you might look at geolocation data from mobile devices to track foot traffic at businesses. These insights come from what we call alternative data. Some hedge funds go a different route, pure speed. They place their computers right next to stock exchanges, cutting microseconds off every trade. That lets them spot tiny changes in supply and demand ahead of everyone else, racking up tiny profits thousands of times a second. We call this high-frequency trading, or HFT. But whether you're using alternative data, high-speed trading, or building portfolios like we saw today, the quant's job is the same. Find patterns, model uncertainty, and turn predictions into profitable trades. That is quantitative finance.